Hello and welcome. My name is Brad Maclean. I'm co-founder of Regulation Asia. In recent years, crypto assets have become increasingly mainstream for investors. However, banks and institutional investors have played only a small part in this massive growth. As financial institutions increasingly show interest in crypto assets and their related derivatives, a challenge would be the need to address the lack of legal standardization and documentation. And this is what brings us here today. I'm sitting with Scott Amalia, Chief Executive at ISDA, to talk about ISDA's initiatives to create a framework for standards and documentations for crypto derivatives, and how ISDA is working with market participants to facilitate these efforts. Welcome, Scott.
Thanks very much for having me.
Just, I guess, to kick everything off, it'd be good if we could get your perspective, I guess, from ISDA's perspective. What is the state of the current crypto derivatives market? And is there a demand for standard documentation like an ISDA agreement at the moment?
Well, at the moment, firms tend to use adapted forms of equity or FX or commodity definitions to document their trades. Other firms may use entirely bespoke form of contracts. So while these templates are legally robust and they're up to the counterparties to use, and that's entirely their decision, they necessarily require a significant degree of customization to address some of the most novel features in crypto assets. For example, if you look at the blockchain, a hard fork, and think this looks like a bit like a stock split under the equity definitions, in the sense that you ultimately end up with two distinct assets. While you could use the equity provisions at that as a starting point, you would need to adapt it to reflect how this actually happens on the blockchain, which of course you have two forked paths, and you're going to need to decide which one will be followed. Now, as the market grows and technology evolves, it is inevitable that additional issues and risks will be identified. In turn, this will compound the degree of customization required for those product templates, and that's what we're going to be focused on going forward. To bring all the benefits of standardization to bear, it's really important that we create contractual standards that respect the unique characteristics of this market. I really do believe that crypto assets are a unique asset class, and we don't necessarily have to bin them in an equity, FX, or commodity definition. In fact, we shouldn't. We should just respect it for what it is and deal with its idiosyncratic elements and behaviors, and really get down to focusing on how do we develop good, robust product definitions, standardize as much as we can, so we can hand that over and the industry can fully utilize and take the benefits of standardization to apply that to their trading behavior. This will allow institutional players on both the sell side and the buy side to get their arms around this and to meet the new innovators on their platforms and trading these new assets. It's quite exciting, actually, and we're really looking forward to tackling this job.
So you've mentioned those novel challenges. I wanted to just take a little bit of a deep dive then. I mean, when you look at issues such as forks, valuations, market timing, how is this influencing your work on standards, and how are you addressing these types of issues?
Well, first of all, we laid it out in a white paper in December. You can find that on our website, ISDA.org. There's a white paper that kind of explored the very issues that you identified, forks, valuations. And we're thinking about those as examples and simple examples to say, right, these are unique. Forks are unique to this asset. We need to come around with valuations and settlement times to help traditional finance kind of adapt to this. If you think about local trading day, right, we've had local trading day in definitions because these products are traded in Singapore, or they're traded in New York, or they're traded in London. Well, now they trade 24/7 all over the world on a blockchain. There's the jurisdictional reach is now very tenuous. You're trying to figure out, well, where does settlement occur? What time zone do we want to use? If we're going to do mark-to-market accounting, how do we think about taking a snapshot in time and valuing that? So let's sit down. Let's bring the traditional finance people that they're around the table at every is the discussion, and bring the DeFi as well. And we're getting many more members that join us that have become members, and bring everybody to the table. Have a conversation about how we sort some of these things out, so both traditional finance and definance, kind of get what they need in terms of definitions that can be applied and traded effectively, efficiently, and at scale.
So you mentioned the convergence, I guess, between DeFi and traditional finance, right? So I guess what is the ultimate outcome of this work? Is it about bringing, I guess, greater participation from banks and institutional investors into the crypto asset, into the crypto markets? And is there a time frame?
Well, the time frame is now. I mean, we're working on this now. It's important. It's a $4 trillion market, depending on valuation. So it's growing rapidly, and it's all over the world. So people are thinking about this. Institutions are now coming in. Traditional institutions are now trading these products. The value of standardization benefits everyone, right? It is not. It gives you a scalable template rather than arguing about what should go in your definitions or how things should occur, what things should occur if a default comes into play or there's a problem, or these are issues that your lawyers need to sort out for your institution. Let's tackle those at the front end, standardize as much as we can so people can begin trading and not arguing over definitions or behaviors or outcomes or what ifs and therefores. So that makes everybody's life a lot easier because people want to trade these things. They don't want to argue around the table with their lawyers. So it will also help as we see the market evolve from a spot market with the big coins being traded today to more derivative products that are and offering cash settlement for some of these products. So if you think about some of the traditional finance participants, the Basel rules may make it prohibitively expensive for them to hold the spot coins, the physical coins. So therefore, cash exposures and derivative exposures are much more preferential in terms of how they manage their exposures to these products and make markets. So when you think about options and forwards, some NDF-like products, these are all derivative products that you can think about in terms of growing those and applying those. So I think there's a lot of innovation that can still occur, particularly in the US, which is really a heavily spot market right now, and it'll evolve to a more derivative-based product.
So you've alluded to the evolution of the markets from spot to derivative, but when we look at the markets as they are today, what types of different derivative instruments do you see are kind of the ones that are mainstream, and where do you expect this to evolve over time?
Well, it is. We see a lot of trading right now, growth in trading in the options, in the forwards, in the NDF type markets, and those are considered, derivatives. We'll see more of that. Still heavily, focused on the spot market, but the evolution is going to be over time, and we need to get to work now in order to develop those templates, get everybody agree to those templates, and then push those out into the market. We do think about them in terms of making sure that we have a digital framework, fully digital. Not all of the existing ISDA definitions today, but soon in the future, are digital, right? Some are still paper-based. We acknowledge that you cannot bring a paper document definition to a digital food fight here. So let's get on with it. Let's think about these in smart contract terms to make sure that these can be fully automated and put on chain. We're thinking about everything, which contracts would lend themselves to a smart contract. Now, the ISDA master agreement is a fairly lengthy, long document that is not necessarily something you would put on chain, but it does serve as your counterparty relationship documentation that is so essential as you think about documenting your trades and beginning to think about how institutions want to trade. So, making sure we have as much of that as we can ready to go in a standard template so you can get on with trading. And then we're going to continue to push and focus on using more and more smart contracts. Now, the great part about it is I don't have to figure this out, right? This is what we're going to benefit from, having all of the participants in the market today join us in the conversation. As I noted earlier, we're having a huge amount of participants join us as the members to sit around that table. I think we have over 170 institutions signed up for our digital asset working group today. And this is the group that needs to think about and tackle the thorny questions on the different product issues, right? How do you deal with a fork, settlements, valuations, et cetera? And also we'll listen to this group in terms of what can be turned into a smart contract that can be put on chain. This is not trying to take traditional finance and make crypto assets conform to that. In fact, the other way around, we're thinking about how we evolve traditional finance to make sure that it's suitable and it can manage crypto asset trading in a safe and effective way.
So you'd mentioned how your membership is growing, the community is growing. When we look at this initiative, I mean, where is the bulk of the demand coming from? Is it these new industry participants, or is it the traditional finance groups? And I guess more importantly, how do you expect this to change over time?
Well, the new members that are coming to ISDA are large institutions, many platforms, some entities that are making markets in liquid products and cash markets. And so right now we're conducting a survey of who exactly is, what business line they're in and what kind of activity they're in. That'll help us better understand their businesses, because they actually do multiple kind of services for the industry. So some are traders, some are platforms, some are both. And so we're trying to figure out who's around the table and what function they play in the market. But it has been some large, well-known institutions that have come to the table and are platforms. So I think they have a real interest in offering standardized contracts, terms, ultimately smart contracts that kind of serve as those templates that they can code into the rule books of their platforms and say, let's talk about how we're going to trade these products and expand that into the derivative space in a much more standard way. Now, will it be lit markets or kind of OTC markets? It doesn't matter to us, right? We need to have those standardized terms that can be applied to either one of them. And the markets are going to evolve, and as liquidity grows, and it probably goes from an OTC market to maybe a lit market. Maybe you see some options being in a very lit market here, like we have in current traditional products. We need to be technology agnostic and product agnostic, and not try to create some old format to suit this thing. Let's respect the asset class for what it is. Make sure that we offer standardized templates and definitions that are suitable, but also can evolve, because we're probably not going to solve all of this in one go. We're probably going to solve some of the bigger issues or some of the most important issues first, and then continue to iterate and update the documentation, as well as the definitions. So when you think about this, we've changed the way we develop our definitions in a digital format. We need to create a golden source. Right? We cannot say the 2006 interest rate definitions and then add 80 amendments or templates to that original definition while not changing the definition. That is not suitable for a digital universe, right? We need to think about this as always having a golden source that can always be referenced and up to date. So we're changing the way we even think about how we develop our definitions that make it suitable for the digital world. And so we will create, ideally a digital crypto asset and evolve that as we solve more of these problems and get more standardized terms and definitions.
Interesting. I quite like we want to be technology agnostic, product agnostic. But I guess if we're looking beyond crypto to what's next, towards the tokenization, everything, what do you see is the role or the potential role of technology in traditional finance?
Great question, and there my crystal ball is a little fuzzier. I think that's a really important big question. NFTs and crypto assets and things like that, which I recognize are the same thing, but they're different products. So traditional finance I think is going to be very slow and cautious in adopting some of these blockchain technologies, which is fine. That's how they do it. They have a real risk. They are prudentially regulated, they are market regulated, they're going to be very cautious here and make sure that there are no risks that they can't anticipate here. So they'll tread carefully into this. So I do wonder about in terms of taking blockchain technology and totally transforming wholesale markets. I think it's going to be slow, but I do think there are going to be different asset classes that do come in and offer some transformative opportunities. And I would probably think it's kind of in the equity space, maybe stock lending, some of the repo markets, things like that would offer the best opportunity, because you have such huge retail demand for this today, and that's what the customers are demanding. So I think that could creep in. Now, the interest rate complex, maybe credit products, probably a little slower in terms of innovation from a technology standpoint. much more of a closed shop. But I do think the equity space is and equity definition or derivatives might be the opportunity to merge traditional finance and DeFi.
Wonderful. And with that, unfortunately, we're out of time. Scott O'Malley, Chief Executive at ISDA, thank you so much for sharing your insights today.
Thanks for having us.
Thank you.